Hello everybody, in this video I will explain what is the best interest rate to choose. This is based on my personal experience. I'm not a professional, but I'm saving a lot of money with a good interest strategy. But anyway, please speak with a professional before taking important decisions. So, to select the best interest rate, you have to set up a strategy. To set up a strategy, you have to know which is the current interest rate, and the foreseen interest rate of the next years. This way, you can calculate the money you save in a certain time, and decide how much you want to risk. Once you have calculated the possible savings, you can choose the best interest rate for you. Generally speaking, the fixed rate has the lower risk, the variable rate has higher savings. Let's understand why. The fixed interest rate has low risk, because your monthly payment will not change during the whole mortgage length. As you can see on this graphic, the monthly amount will not change from beginning to the end. The monthly payment is composed by the principal, or in other words, the loan amount you are giving back to the bank, and the interests, or in other words, the money you are losing and that the bank is earning for the loan. This graph is the typical scenario of a fixed and low interest rate. In red, the money you lose; in blue, the loan you are giving back to the bank. As you can also see, in the beginning your monthly payment is composed more by interests, while in the end you pay back more loan quotes. What about the variable interest rate? Well, the interest rate changes from time to time. It could increase or decrease, and this affects the monthly payment, that increases and decreases accordingly. It depends on market conditions. If the economy is strong and inflation is rising, the variable rate rises, otherwise they decrease. As you can see here, the variable rate changes from time to time the monthly payment. In the example here, in the first years we have a decreasing rate and the monthly payment goes from over $1,000 to about $800. After that, the rate increases and our monthly payment goes to about $1,300, to decrease then again. If we compare this example with the fixed interest rate example, we see that the red area, that represents the interests, could be similar in both examples. This means that the money you are throwing away for interests, could be the same at the end. As a strategy, it could be better to choose a variable rate when it begins to go down, and in that years you could save money. Let's suppose that with the lower variable rate, you save in that 10 years about $15,000. You could give them back to the bank, lowering your current loan. So if you decide to give your saved amount to the bank, you have paid back more loan than foreseen. This way, for the whole second phase of your mortgage, you get an overall reduction. This is valid for the variable rate case, as well as for the fixed rate case. The more money you give back, the more overall reduction you get. You simply pay then a lower monthly payment, related to the residual amount of debt. This operation is possible if the bank agrees on this, so before opening a mortgage, make sure the bank agrees on this kind of operations. The more money you save, and give back to the bank, the more monthly payment reduction you get. And then, more reduction you get, the more money you can save, and give back again to the bank. This is the way I reduced my mortgage. It's a good general strategy to save money. Let's go back to the normal variable rate case. As you can see here, in the second part of your mortgage, the higher variable rate increases your monthly payment. So you have to pay attention, to be able to afford a higher monthly payment in that case. To avoid this problems, there is a third type of interest rate. The mixed interest rate. It is a combination of the fixed and variable rate, with the feature of limiting the monthly payment to a maximum value. As you can see here, the mixed rate is a variable rate interest with a limit. If the variable interest goes higher than a certain limit you can define, your monthly payment does not exceed your decided limit. When the variable interest rate decreases going under this limit, your monthly payment decreases accordingly. This security system has a cost, so the bank generally applies a margin rate on this mortgage. So, which is the best rate to choose? It depends on your strategy, and how much you want to risk. So, I hope this tutorial was helpful to better understand interests. Thank you for watching Simple Money Tips. We are working on other tutorial videos, and if you have some questions please write them down here. If you want, Leave a like or subscribe to this channel. Thank you very much.